So finding the mover and the logic chain. Oops, let's come back to that. Let's see what I want to go with next. So I had a question today. I want to cover that before we get into the daily report. I want to talk a little bit about this. So I think Dave Rushing, are you in here tonight? No, but Dave asked me the question, and he gave me a symbol to look at, and I forgot what it was. But he asked me, "Hey Ken, what do you think about REITs?" So I have an opinion about REITs, but remember, my opinion about REITs is filtered through my lens. So instead of answering, what do I think about REITs? Real estate investment trust. So that's an ETF. Actually, let me put that. No, a REIT is a holding company that owns properties that pay dividends. And then these guys do their due diligence to find undervalued company or undervalued properties that should be earning a lot of money, and they want to buy those at a discount. And then in the management of that portfolio, collecting rents and all that jazz, then they can pay a very high interest rate. So that's a nice alternative to, owning bonds or treasuries or other income producing instruments, which are all getting beat down because of reasons, So in the search for income, REITs become a very useful tool. So Canada has some that are like petroleum holdings and all that. But so the real estate investment trust is an interesting way to approach the challenge of how do I balance the volatility of capital investments where I'm going for share price improvement and then just get paid a high percentage. So you could try to find companies that pay a good dividend, but then you're exposed to that company risk. So if you wanted to offload some of that risk, you could look at an exchange traded fund that owns a lot of REITs. And so you're getting the benefit of an extra layer of due diligence. And then you're looking for either a residential property holder where they're collecting rents from renters, or you're looking for a commercial property where they're collecting rents from businesses that are trying to buy it. So that's one of the arguments behind Simon Property Group. So Simon Property Group is a company who pays a good dividend, and they're trying to find good commercial properties at a discount. And by good commercial properties, I mean ones that can get filled up with tenants who are going to pay reliable rents. Well, that's problematic in my view in this re-engineering of our economy. So that's put commercial real estate, in my view, at risk because a lot of that is owned by mid-cap companies who don't have the same kind of financial horsepower as super large caps, and and these mid-caps aren't getting the same kind of Fed support to prop up their balance sheets, so it puts them in the squeeze. That, in fact, one of the strategies, if you were a conspiracy theorist, is you might say that, hey, we're going to give a lot of money to the uber large caps, including some of these holding companies, which is coming out in the news, all these asset management people that are getting free money from the Fed. What? If they were shrewd and savvy, they shouldn't need that Fed help. So there's a small problem developing there for them. It's getting some attention. While the people suffer, these guys who are connected are getting free money. Well, the idea there is that those guys are going to use that money to buy financially strapped mid-cap and small-cap companies, and when their little Fed boost runs out and they can't make payroll anymore, then these big guys come in with the free money and repossess or just buy them outright for pennies on the dollar. So that's going to be one of the ways those real estate investment trusts could become amazing. If some large cap money came in and then started buying these assets, then they could pay a nice dividend if and when the economy starts to rebound. Well, why could that be the case? Well, because the Fed has shifted away from capital price protection to consumer demand, which means they're going to be start pumping money into people's hands so they can spend it in those small and medium-sized businesses. And now maybe these guys can start making some money and paying their rents. So there's some kind of squeeze play potentially going on. So those are some of the things that I think about REITs. And because these are revolutionary times, I'm not so sure that the old school way of thinking about REITs as a reliable way to get good interest payments, but also be exposed to the possibility of capital appreciation through share price improvement. So you were getting a twofer, a chance to increase on the increasing value of real estate, but also to be able to draw some of the income that's coming out of rent and rent collection. So strategically, that's a pretty good idea. So what I thought I would do is say, instead of saying what I think about them, you've heard a little bit of that right there. Instead, I've decided to reframe that and say, what I'll tell you about instead is, how do I think about REITs? Because how I think about REITs is more than just what I think about them, but it's what I think about them in the context of other choices that we got to make as a decision maker. Everything's going to come down at the end of the day to that decision. Yes or no. Am I going to buy it? So we don't want to stop with just listing things about REITs, but we want to always serve the decision maker who has to decide what to do. So how do I think about REITs? I think about REITs in the same way that I think about everything else. And these are the basic kinds of models that run through my head as force of habit. So the first thing that I'm going to think about is the frequency of the decision. Now that I'm going to invest some time thinking about REITs, what kind of a decision is that in support of? Is it in support of a strategic decision, an operational decision, or a tactical decision? So this equates to core, swing, and day. So if the little day trade decisions are something like the frequency of the decision equates to a time horizon, how long does that decision have to be good for? Well, as a day trader, it only has to be good for a day, and each day is a new market. On a swing trade, I might be taking a decision every 3 to 10 days. I could end up holding, and nowadays even less. If I made it all on the first day, I might say, you know what, that's enough. But really, I'm looking to make one decision in a 3 to 10 day period. So I'm making multiple decisions as a day trader, where I might only be making one decision as a swing trader. And so over the course of a month or whatever, I might be making 4 decisions over 4 to 5 weeks in a series of, hey, maybe it's up and gets to a point, and then it's going to be down, and then it's sideways, so I'm standing off, and then maybe it goes up. So I could very easily think about REITs as a swing trade in 3 different ways. Hey, here's one, because it's sold off, I'm ready to go long. So I think about it as a long swing. And here's one where maybe it's a supported winter crossing. Hey, I'm now thinking about it that it's a good operational short swing. And maybe here's one where I'm just stalking it because it's a sideways quiet channel. So I'm just waiting and bracketing. So I'm actively not trading it, but I'm prepared to trade it. And then maybe it breaks out of the normal range and gives me an abnormal move, and that surprises me. That's finding the mover on a swing trade. So in the operational time frame, what I think about REITs might change 4 times in 4 weeks. it might change 25 times in 25 days at the tactical level. But if I'm excuse me, if I'm thinking strategically, for me, that's probably 1 month at a time and then reevaluate. Now, I'd like to be able to hold that for 3 to 12 months. If that thing started outperforming on a relative strength basis, and each month as I reviewed the bidding, it was still dominating in the ETF2 or the BMR portfolios and was a very good choice, and I would be willing to hold it with the core portfolio for another month. So what I think about REITs in that environment is about once a month, and how long does that decision have to be? So once I add a frequency of decision and a time horizon in there, now suddenly the nature of the question has to change. What I think about them as an opportunity and how they're organized and when they could be useful remains the same, but depending on which of the time frames I'm looking to make a decision in, I could come to very distinct and different possibilities. I could actually be long in the core, might be willing to take a operational swing trade, and I might be playing turbo in both directions intraday. So what do I think about REITs? So it really depends based on that frequency of decision and the time horizon. Well, let me think about it down here now in terms of a market segment. So, real estate investment trust, is a subset of the market, and maybe it's contained inside the larger real estate. I mean, there are things I could do for real estate that were not REITs. So it's a subset of real estate, and that's an alternative asset class compared to, say, bonds and maybe equities over here, and then maybe currencies and commodities. But there's a real strong connection in here between a relationship, you might say, between bonds and real estate investment trusts, because they're both interested in gaining income. So I might look at this whole subset over here about income producers, and then maybe in equities I'm looking at growth opportunities, and maybe currencies I'm looking at swings, and maybe commodities I'm looking at swings and tactical trades on the basis of where we are in the business cycle. So I can divide up market segments into different categories, and then I could consider REITs as one of the choices within this more broad base of income producers. So what is it that I need this investment to do? What am I looking to get out of this? Am I going to buy it because I think it's low priced and the share price could go up? Or do I want to buy it as a source of income to supplement or offset the volatility that maybe comes from these other sectors? So now I can come over here and look at the broad strategy that I'm trying to come up with a candidate for. Am I trying to buy this as a form of insurance, to protect as a hedge? Am I looking as a long-term buy and hold as part of maybe the strategic category? It's stable and secure, and maybe I get some, maybe I was able to buy it on sale and I can look forward to, the share price going up, but in the meantime, I'm going to get a nice dividend payout, maybe. Maybe it represents a growth at a reasonable price, where there's sort of a risk and reward and a PE ratio is considered. Or maybe I don't care about the income at all, but I'm looking at this thing as a competitor for share price growth exclusively, and I think that there's a chance for it to appreciate dramatically if a bunch of buyers come in. So maybe I am now comparing it against the other growth opportunities like a Tesla or an Amazon or something. Or maybe it's just something that I'm playing on a short term, and maybe I have some kind of theory, so I'm approaching it with my speculative money. So now I can take a look at the different buckets of the core and the swing and the day trading and say, which one of those categories am I trying to find a broad strategy for, and what's the purpose of this as an investment vehicle? Which one of those broad needs am I trying to satisfy? Well, I can also think about this thing now in terms of, performance expectations, not just where it was or where it is, but what has it done? And I might look at long-term historical performance. Let's call that I'll just say maybe a 300-day look back. What's it done? Because maybe it's, as a asset class, it might have gone through some share price appreciation like that. Or maybe it was just, maybe it was something like this, where it's just been doing nothing but going up and up and up. Or maybe it was this thing was way high and now it's come down and is just starting to hook. So all three of those are three different long-term look-back periods. Maybe I'm looking at weekly or monthly. Or maybe that's if I just use the 270, since that's the closest of the RLs. And then maybe I'm looking at current performance as that 30 period, the health of the trend now. And I can now distinguish between where is it in the long-term historical performance, and then what has it done lately? And then in that comparison, I may be able to find some relative advantage. Like maybe it's in a super pinch where the 270 and the RL10, are identical. Okay. Or maybe there's this historically wide gap between them. And now they're just on that basis, there may be some reason to think of it in terms of a speculation or a long-term buy and hold because of value or whatever it may be. So that's me just looking at different historical time frames against itself, or maybe even against some other peers. Now I might do some relative performance, and I might look at something like the blended monthly rebalancing or the ETF2 and say, or the RLFF, and say, all other things being equal, hey, here's where the REITs are stacking up in terms of strength and consistency and quality, or, if I'm using the BMR, I'm looking at percent performances over different time frames. So I can now place that inside a scale of 1 to n that includes all of these other asset classes, and I can just evaluate it in terms of risk and reward and recent performance in that kind of a mode. I might now suddenly come back over here and say, let me consider, now that I've considered all of those different elements, what are the strengths of REITs as an asset class, as a thing to own? Why should I own this rather than that? Well, what are the strengths associated with REITs? What are the weaknesses associated with REITs? Taking all of these different lenses into account. That's sort of an internal to the REITs. I could also look at what are the opportunities and threats, right? So I could, under the opportunities, I could make a list of things that are favorable risk to reward. Here's the downside risks of being wrong. So I've itemized all these strengths and weaknesses. Then I can go to category 1 and figure out how I can put my strength onto an opportunity to seize it. So category 1 strategies are, how do I exploit an opportunity with the strength? The next thing I look at is category 2. How do the risks of the itemized threats get on my weaknesses and put me at exposure to disaster? And so category 2 strategies are, how do I protect my weaknesses from the threats that are out there? What can I do to minimize the potential damage? When I'm considering his threats, it may not be enough to just avoid it. I might have to use some of my strengths to defeat the enemy threats. So those are the category 3. Now, I don't really want to have to do that because I have to divert some of my assets from my strength exploiting opportunities, which is where I'm going to win, and divert it over into category 3 and use some of my strength to prevent the enemy from winning. So I don't win by doing that. I just prevent him from winning. But that's a diversion of my strength to stop his threats directly. Category 4 are some low risk things that I can do to reduce some of my weaknesses. Even if there's not an immediate threat to them, I can just do some good low cost, low risk things that just make it harder for me to be attacked. I don't even have to wait for a threat to emerge. I can just do better. Like nutrition and exercise and sleep and building up my emotional resilience. I can just work on weaknesses and just get better. And eventually those things might even migrate to where they're things I can rely on. So when we do this SWOT, strength, weakness, opportunity, and threat analysis, and then combine them, we can find these 4 different categories of strategy. And then a 5th category is the trading plan, in which I consider the individual elements of strategy, 1, 2, 3, and 4, and then I decide which ones I'm going to do. I only have a certain amount of resources that I can put. How am I going to spend them on this blend of strategies from 1, 2, 3, and 4 becomes my actual action plan, and it should reflect my risk and reward, and it should reflect these different time frames and all these different lenses that I've looked on. But no matter what, this final decision that I'm going to make, how do I think about REITs and what am I going to do about it? What's my action plan? I'm always coming back to this central decision maker's mantra, and that is, what's the opportunity? What's the risk? And then what's the opportunity cost that if I take this trade, what are the other risk reward opportunities I'm giving up? That's the opportunity cost. A choice to trade the REITs in whatever time frame and in whatever fashion I'm doing it with, for whatever reason. A decision to trade the REITs in that way is a decision not to trade some of these other things. I've taken some of the assets off the table. So, in a nutshell, a practical way of doing this is that multi-time frame, MTF, MLA, multi-lens analysis. That becomes the procedural way to start itemizing all of those reward to risk opportunities from the different lenses. It takes into account the strategic, operational, and tactical time frames. It considers this as one candidate compared to all the other candidates. I can bring in all of these other elements of analysis for performance, and from that, I can consider ways I might decide to trade it, and then that becomes, the how do I think about the REITs? I think about it so that I can make a decision on whether or not to include it on my plan. So that's strategic planning right there. If it's on my list of things to prepare, I can now go from plan to prepare, then to execute, and then assess. So after I've thought my way through it in planning, now I can go prepare it in the usual way. And that's where the multi-time frame, multi-lens analysis helps you with the trade framing. And then we just pull out that little checklist of framing the trade. So, for Dave, when you hear this, what do I think about REITs? And how do I think about REITs? There you are. So what do I do about it? Well, if you've gone through there and you think that that's worth preparing, then what I think about REITs and how to trade them is what I'm going to come up with after I do the trade frame. So if you want to really learn something, pull up one of those REIT symbols and do the 7 questions of the trade framing process, and then come up with a plan that's directional neutral and identifies the entry and exit points in both directions, and it answers all the questions of the trading process. So you now know how I'm going to answer Any question that starts with, hey, Ken, what do you think about something? What do you think about energy, Cisco, Alcoa, uh, um, the Aussie dollar, um, cyber currencies? It doesn't matter. That's exactly what I do on every opportunity that comes in. An acquaintance of mine, a business associate, asked me, uh, did I want to invest some money in a cryptocurrency marketplace as an owner of an exchange in which cryptocurrencies would be offered for exchange? And they had some scheme to do that. And they had some interest. It was going to, cost $100,000 to buy in a share, to be a partner in that consortium to do that. The opening bid was $100,000. I went through this kind of process, and really, it was always at the end of the day was coming down. I understood what the opportunities and risks were, and then I compared that to the opportunity cost of what could I do with $100,000 as in the next 3 years as a pool of capital versus $100,000 tied up for 3 years in that opportunity versus $100,000 with cycling through, because that $100,000 is not just what it returns on the first trade or sets of trades, but if I'm cycling that $100,000 as inventory and I can start piling on, making money with that money, that's part of the opportunity cost, is the compounded return on the other opportunities that are out there. So I might now have to come over here and put not just bonds, but I have to now put, business as another slice of the pie in here. And maybe I have to put education in here as a general purpose slice of the pie. Hey, that's like for money, right? Well, no, it's also time. And now we can start thinking of ourselves as a business enterprise. And all of the activities that you are doing, the sum total of that is your brand. And you've got a business plan that accounts for all of that professional time, money, effort, attention, teamwork, resources, and all that stuff. And now you should start judging your activities in light of that business plan for success. And then inside that, there is a trading plan for success. And inside that trading plan, there are trading systems and strategies, and there's infrastructure and support and capital and all that stuff. So you look at these activities through this kind of so what operational lens. Never lose sight of the fact that you are trying to make the best decision on the decision that is the best to make, right? You want that to lead to action, which has consequences and has a risk-reward profile. And what's the best use of my time is to make the best decisions that I can afford as quickly as I can, but not too quick. And then get lots and lots of those decisions made. So that's one of the arguments in favor of tactical trading, that if you're good at decision making and finding the movers and having a directional neutral approach, and you can disassociate your identity with any one particular decision so that you can make lots of decisions, you're taking sort of a shotgun blast approach at the flock of geese flying overhead. You're willing to give up some of the perfect efficiency for a really good return on capital. A shotgun shooting at a flock of geese within range is a high percentage play. We're trying to stampede buffalo off a cliff. Instead of going and try to arm wrestle a buffalo, if you can get the buffalo to run off a cliff, there's a certain efficiency in that. So, Dave, what do I think about REITs? Let me reframe that and say, how do I think about REITs? Let me reframe that and say, how do I think about opportunities? And how do I think about systems of gathering many, many opportunities. So I'm not trying to find the perfect one. I'm trying to find a broad selection of pretty good, really good things and handle them pretty good, pretty well, and then just use the law of large numbers and statistics to keep refining me into better areas that are suited for my skill set. That's what you're trying to do. Not trying to pattern match me step by step, but you're trying to discover your optimum payoff quadrant, inside this whole range of thinking. So in the hybrid trading course, there's a lesson in there that talks about design thinking for strategic planning, coming up with your own 5-year strategic plan for yourself that takes a lot of these things into account, not just the trading, but also the best use of your time and attention, and how to do those things. So maybe I'll go find that lesson and post that.